Welcome everybody to our January 2010 market roundup. Across Australia, our housing market has again done well, with an average rate of growth of 1.67%. Sydney and Melbourne, however, have failed to perform in line with the rest of the country and are taking a slight breather. Sydney fell back a little by 0.5% and Melbourne by 0.78%. These adjustments followed very strong growth periods up into December 2009. They were in fact necessary, and the housing market has been falling back in growth terms a little bit in these two states since about October last year. While on the surface it doesn't look like it's good news, my view is that in fact it is, because the bottom line is if our housing market advanced at too rapid a rate, the Reserve Bank could consider that we were entering a period of a house price bubble and adjust interest rates much more strongly than they have. Today we saw a rise of 0.25%, and I'm not expecting further increases for a little time now. The rest of Australia has clearly performed well. The best performing capital city was 1.3% for the month of January in Adelaide. Regional areas, best performer, New South Wales at 2.62%. Again, a very, very good result. Auction clearance rates in those capitals which are predominantly auction markets, i.e. Sydney and Melbourne, again produced very strong results. The auction clearance rate on average is around about 75% each week, and the volumes of properties that are up for sale in our markets are around about 20% higher than they were this time last year. So overall, our housing market is clearly in a growth phase. Looking at the typical growth phase, we would have to say that normally we see two peaks in the growth cycle or phase of a market as it advances forward. We see a small advance first, followed by a much larger advance. The numbers are telling me that in fact we have seen that first phase to the period up to October, and as the markets adjust a little now, we can expect the secondary phase to begin towards spring this year. We should not expect, however, growth rates of the same magnitude that we have seen in previous housing cycles. Affordability is an issue. Affordability, as a consequence of how higher house prices and higher interest rates, will moderate the rates of growth that we are likely to see. I come back to my statement earlier that our markets are constrained to some extent by affordability. So the answer to that question is simply that we should look for housing that is affordable for the majority. If we can find housing that is demanded by the majority, then that demand will lead to house price growth. In my view, as we look forward, it's the total rate of return that's going to be important. Capital growth singly no longer will be the most driving force in a housing market investment. I form this view based on history and based on the unaffordability of housing. Let's start this whole process by actually having a look at that history and looking at a graph that actually is for Sydney from 1901 to today. Some smoothing has been undertaken so that the numbers are more evident. From the graph you will notice that the total rate of return is quite acceptable. On average has been around about 15% per annum. There are few asset sectors that can provide you with that total rate of return. You will also notice that the rental yields are now at the lowest recorded in history. However, they are just starting to move forward. You will also notice that the rates of capital growth are falling away in each housing cycle. And at this point, we are not in any way, shape or form performing as well as we have in the last 50 years. The reasons for this lie in affordability, and Sydney can point to the future that we can see as other capital cities move towards this inaffordability. Sydney in fact produced the lowest long-term rate of return or average rate of return over the last 20 years of any capital city in Australia. The low-cost capital cities actually performed well and performed best. We'll look at the reasons why we invest in housing in our next release. However, for the moment, what you should be focused on is a total rate of return in housing, and you should be focused on identifying investment properties which are affordable. That means that you should be looking at properties which are on the price range of somewhere between $350,000 to $600,000. If you do that, there will be adequate and quite strong demand for your houses that you invest in, and as a consequence, good capital growth. May I point you to buying the Best Rent report. That report provides you with the best 100 suburbs throughout Australia that are likely to provide the best quality total rate of return. That is, an adequate capital rate of return and at the same time an adequate or good potential for growth and good rental return. It is in fact the suburbs which will provide you with the best balanced total rate of return. Good luck with your investing over the next month, and I look forward to speaking to you again in March.